Hello, everyone. I'm Arvind Chari, CIO of Q India UK, which is an affiliate of Quantum Advisors Private Limited. Uh, we are again here to talk about how the global markets and the Indian markets have performed over the last 1 or 2 months, and how are our portfolios positioned, what do we expect, and how should investors think about allocating and specifically allocating to Indian and Indian asset classes. Of course, this month started with the budget, the last budget before the term of the government ends in March, and then we get elections in April and May of 2024. Generally, in the last budget of any government, you tend to expect what we call populist measures or more handouts or more freebies. And very surprisingly, this government I didn't go that route at all. There was hardly any major substantive increase in either subsidies or freebies, as they are called, or some measures to try and influence elections by handing out money and by giving subsidies. And it was a very what we call prudent budget. The government continued to focus more towards capital expenditure and building infrastructure as compared to trying to support consumption. We've always had mixed feelings about it, that we still see consumption and incomes being lower. It had got impacted since 2016 after demonetization, and some aspects of the economy have still not recovered their income levels or their consumption levels to that extent. But this government is very clear that they'll focus on supply side as compared to boosting demand side. So you should expect some more weakness in consumption till the time the entire increase in capital expenditure and then the investments by companies gets done, and then what we call trickle down into activity and consumption and income at the lower level. Till that time, you should expect some more softening of of demand conditions, which is reflected in consumer staples, consumer discretionary spending patterns that we are seeing in corporate India and the economy in general. But by and large, maintaining and taking the fiscal deficit, which is the difference between what the government earns and what the government spends, to a slightly lower level than what was expected, is positive from a macro perspective. So when a government focuses on cutting fiscal deficit or consolidating fiscal deficit, as it's called, it is a positive sign for the inflation, is positive sign for interest rates, and it is a positive sign for the currency in terms of macro stability. And so that got reflected in the bond market, and I'll speak about that. Immediately following the budget was, of course, the monetary policy, which is the RBI's decision on interest rates and liquidity. Although there are expectations that the RBI will now change its stance from what they have been talking about, of withdrawal of accommodations, what they had given in COVID, to come to a neutral stance, because we believe that inflation is well under control. So if the government doesn't spend too much on consumption and boosting incomes, they've also henceforth kept a lid on inflation. So today you have headline inflation somewhere around the 5.5% mark. But core inflation, if you remove aspects of food and energy, is now below 4%. So the demand conditions in many segments are pretty weak. And the market was expecting that the RBI will change stance and indicate a rate cut sometime in the first half of 2024. But that didn't happen. They didn't change the stance. They were reasonably what you call hawkish in terms of their inflation expectation. They want headline inflation to go towards that 4% target, which is exactly what you saw from the US Fed as well, right? The global markets were expecting the US Fed to either cut or indicate a rate easing very soon, and they pushed back on that. They've said that they still need to win the war against inflation, and demand conditions are still strong, and market should not expect a rate cut as soon. And you've seen an increase in bond yields in the US quite dramatically, especially in the front end and in the longer end. In India, it's a bit different, although the RBI did push back, and you saw a bit of increase in the long-term bond yields in India, short-term and long-term. But generally, the conditions in India are better. As I said, macro is much more stable, fiscal deficit is going lower, which would mean that supply of bonds will be lower and lower as we get into the next year, this year, next year, and the year forward. And in India, demand conditions for bonds especially is changing in the sense that all of you know that India is now going to be included in the bond index, the global bond index, sometime in June of 2024. And you have seen foreign investors front running that, or people who have India accounts or who can have India allocation have already started making investments. Just in the fiscal current calendar year till date, I think the total FPI investments in Indian government bonds is about $4 billion in about 1 month and nothing, and 1 month and 1.5 months. That's a significant increase, and on the back of close to about more than $10 billion that we got in 2023 as well. So there is significant interest being built up from the foreign investor side into the Indian government bond index on the back of the increase in inclusion in the bond index. And also the certainty that comes from a stable fiscal and a RBI, which is still very concerned and wants to give what we call real interest rates, keeping it very, very positive. Those are all good aspects while investing in Indian local currency government bonds. And so we haven't seen a large drop in bond yields. Like bond yields peaked, 10-year bond yields in India peaked at about 7.5, 760, mid last year, and are now trading towards that 10%, 7.1. If the RBI, the repo rate is 6.5. If the RBI reduces the repo rate, which is what the expectations are in the next, you should see bond yields coming lower, which is why the flows into Indian bonds is increasing, and you should expect some more activity. If I look at a 3-year rolling returns of Indian bonds as compared to US bonds or emerging market bonds in dollar terms, India has done relatively well, but the returns are still, are not that much in positive. So I think we should see a start of a cycle. If the macro conditions remain what it is, we should see a start of a condition where both foreign investors will make returns from bonds and as well as some gains from the currency, because the INR also has been kept very, very stable by the RBI in the last 1 year. Coming to equity markets, you've seen the momentum continuing more or less. We had a very strong 2023. Large cap returns were in the mid 20s. Small cap, mid cap did even better. You are seeing some pullback. There are some days where small caps is falling a lot. Some overvalued sectors like say PSU stocks in India have corrected a lot because they went up a lot on its own. You're seeing some cracks, some visible stresses on markets being overvalued. But in the large cap space, it still seems to be okay. As I told you before as well, the large cap index is much better relatively valued as compared to mid cap and small cap. So if there are valuation worries, there are more valuation worries in the mid and small cap space, or some thematic sectors like PSU as a space. But in the overall large cap space, it is expensive on a relative basis as well as on a historical basis, but it is not as expensive as the mid cap and small cap. Portfolio is positioned very good on from a India perspective, very good on the bonds and the currency. Little bit in terms of cautious in valuations for in the equity markets. And over the next 2 months, and I'll come back and speak to you next month as well. We're heading into elections, so that can, although we say that over the long term, it does not really matter to markets and to the economy, but there will be short-term impact sentiment depending on what outcome takes place, either positive or negative. Global market also, as I said, the market is grappling between whether Fed will cut interest rates or whether they'll keep interest rates higher for longer, as they say, and what does that mean for different asset classes, including equities and bonds and commodities and currencies. So we'll see how that pans out. But from an Indian perspective, I think from an allocation perspective, it still looks very, very attractive to remain allocated to India and to look for opportunities across different segments and different asset classes. So thank you so much, and we'll speak next month again. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.